Hello everyone. So guys, in our last video we have discussed about value added, economic value added, and what is economic value added. So in our last video I have derived three questions: what, why, and how. What, why, and how. So in our last video we have made discuss about what is economic value added, and we have to half an hour to discuss the economic value added in details. So there is nothing more concept remain without in our book. So this is all about the concept what is economic value added. It is described in that video. Okay, so uh, in our this part of video will make why is EVA. Why means what is the purpose of EVA? Why should we calculate EVA? Okay, so this is the video which is going to make the reason of why is EVA. What is the reason? What is the purpose to calculate EVA? So guys, the the purposes of EVA, purposes of EVA. What is the purposes of EVA? Purposes of EVA. It's saying that now you know that guys, the economic value added is the method to calculate the financial performance of a business entity. You know that very well. But to that now you can say economic value added. So why should we judge? Why should we judge our financial performance? What is the reason to to judge the financial performance? Is that not going well or not? If our business is not going well, then we will understand, because the profit rate will goes down, because when the profit rate is going down, then we will understand that the business is not going well, our business entity is going to be hell. but when but why should we calculate EVA to know about the performance of business? B- because of guys, the economic value added is calculated for, not for the owners, not for the management of business. This economic value added is calculated for our general public. So now I will discuss about the purpose of e- the purpose to calculate economic value added. The economic, so I am writing it now like that, so you can copy it now. This economic value added is a financial tool financial tool. I- you can pause the video after write down full of the definition and the purpose. Financial tool by which an investor an investor by which an investor is able to take by which an investor is able to take the proper investing the proper investing decision the proper investing decision prior making prior making investment into farm investment into farm. So what it is, the purposes of EVA. At first, you know that economic value added is a financial tool. It is a financial tool. You know that term very well, because we have already introduced this particular term in our previous video. So in this video I am going to the purpose, the real purpose. So economic valuator is a financial tool by which an investor is able to take the proper investing decision prior making investing into firm. So now you guys can understand that the purpose of calculate EVA is to not to judge for ourselves, not to judge for the committee of the of our business entity or our firm. So the this is the calculation to show our investor who are going to invest in our company, and we are liable to get back the return to them. So it is for investor who are going to invest in our company, in our business entity. So this is the calculation to show them this is that worth it to give to invest proper money in our business entity or not. So here it is, you can see that it is written that economic valuator is a financial tool by which an investor is able to take the proper investing decision. Is that enough to the is that okay to take decision to invest in our company or not? This is the judgment to the investor. So the investor will take decision according to our EVA. And EVA, what EVA do? EVA does EVA EVA's job. What is EVA's job? EVA's job is to show them our performance, the firm's performance, firm's financial performance and performance. This EVA's job to show firm's financial performance in the public, who the general civilians who are going to make investment in our farm. This is the farm's financial performance. So this is the economic, and this is the thing which economic valuator going to show to our investor who are going to be our shareholder. So EVA is for EVA is the calculation for the investor, not for the owners, not for the committee of our business entity. Okay, so according to our business entity's financial performance, the financial investors are going to invest in our company or business entity, otherwise they will not. So after seeing that particular format, they will take decision about to invest money in our business entity. So here it is, this is the only reason to calculate EVA. Okay, there is no reason to calculate EVA otherwise. So now i'm I'm going to inform you guys some important things, that is EVA, economic value added, can be positive. Okay, EVA can be positive, EVA can be negative, and also EVA can be 0. Because of guys, if our EVA calculation given positive answer, then the farm's financial situation is okay. It is okay to invest in that particular firm. If our financial performance is negative, then we have to show that in front of our general civilians, because they are going to take risk to invest their money in our company, and we are liable to get back their return. But if we are not liable, if we are not enough, if we don't have enough cash in our hand to pay them back, so they should not invest in our company. And if so, in the financial market, we can't say to our investor like that, you cannot invest in our company because our company is not making profit. We can show them the negative result, and they will take their proper decision. And EVA can be 0. EVA can be 0 means, if the EVA, this financial performance, remain constant. financial performance performance remain constant remain constant the financial performance remain constant. Zero means constant, so there will be no update. When the EVA valuing is zero, then there will be no update. If the firm making profit in past, then if the firm making profit in past, then similarly it it gaining profit it gaining profit in now. So if the firm earning profit is 30 crore in past, then the firm is earning also 30 crore in today. So it is the result of zero. There will be no reason, there will be no update for increase or decrease. So our profit rate is same. So when the profit rate, when the financial situation, when the financial performance of our firm is similar to past, then there will be the EVA value is zero. If our financial sorry guys, if our financial situation, financial performance is going to up, then it will be positive. If our financial performance is going to be negative, is going to be decreased, then the result will be negative. And if our financial performance is similar to past, then our result will be zero, that is equal. So here it is the purpose, the reason why is economic value added is important to calculate. So here it is guys, there is nothing to uh, share more about that. So it's so now you can guys understand EV is a essential and most important thing in our share market, because share market is the investment market, and the shareholders are going to invest in share market in through their share, and they are going to invest their money in our companies through the EVA. So if EVA showing positive result, then our farm financial performance is increasing. If the farm financial performance is decreases, then it will show negative result. And if financial performance is going to show the equal performance just like before, then our farm will show the performance is remains constant, that's mean zero, there will be no increase or decrease matter. Okay, so it shows the value of shareholder, it shows the value of shareholder. Okay, so now it's all about that. There will be no there will be nothing to explain more about the purpose of calculate EVA. So this is only the reason to calculate economic value added. So it was a why part. Now we'll go for calculation our next part, that is naming that how means how part. It's our third question and last question but not least, that is how what is the how means the calculation, how to calculate EVA. We have already studied what is EVA, we have just completed why is EVA, and now we'll know how is EVA. So how means how how to calculate EVA, how to calculate EVA, how to calculate EVA. So it is all about that. So now I am going to write down some formula, and you have to write it down in your copy with very concentrative listening, and write it down simultaneously. So I am going to write down the formulas. So make a heading like that: formula, formula of EVA. The number one formula EVA. EVA, that is no PAT minus TCE and WACC. At first I will write down each and every formula and then I will explain the meaning of this formula. WACC. Our third formula, EVA equals to no PAT minus OBVC in bracket OBVC into WACC. Our third formula is EVA equals to average capital employed into spread. Okay, so here it is the three formula. These are all of the formula are here. So with this three formula you can calculate any kind of EVA. When this different kind of element will be given in our question, then we will calculate, then we will choose our formula according to the question. So now I will describe each and every word of that formula. Okay guys, so now we'll comes to know that what is NOPAT. What is NOPAT? So uh, so these are all the notations. So they have some sorry guys, so they have, so these are all the coding words. These are all the notation. So I am going to explain these notations. So I am making here an heading that is notation. You guys will just follow this line up. Notations. That is the first one is NOPAT. What does it mean? So NOPAT means, in full form, it is net operating profit. Net operating profit after tax. Net operating profit after tax. The full form of NOPAT is net operating profit after tax. It means, so what does it mean? So it means what? It means the quantum of net operating profit remained in the business after payment of taxes but before interest. So I think I can't explain to reading out through the definition. So I am writing down in this after this heading. So you will make a judgment on that and I will explain it in details. It means quantum it means quantum of net operating profit remained in the business after payment of tax after payment of tax, but be, before interest, but before interest. But before interest. So what is the primary meaning? It means quantum that is calculated quantum of net operating profit remained. The net operating profit, the value of net operating profit remained in the business after payment of taxes. So after gaining the profit, at first we have to pay the tax, and after getting the tax, payment of tax, the amount we have in our hand, but before receiving interest, but before the interest, before paying the interest, sorry, not the sorry, I mistakenly say that receipt, that is payment, but before making the payment of, interest. So after, so when we will get our net profit and net profit after tax, so net profit minus tax, and then we'll get the amount net profit minus tax, the amount. This is the result of net operating profit, otherwise no PAT. Okay guys, so here it is, the real meaning of no PAT: an addition or subtraction of net operating profit, income and expenditure to the net profit figure, and making certain other adjustment for turning accounting profit into economic profit is advocated. So here more meaning are here. To know about net operating profit, you guys can go and search it out through internet. So if you want to know each and every term in our accounting theory, then I will make an more video to understand, to make this um, to make aware you about this particular form of notation real meaning in our business entity. What does it really mean? So we guys know that after making profit and loss, the PL account, we get net profit, and when we will get net profit, then we will at first make payment of tax, and after make payment of tax, the amount we will get, that is the amount of who that is the amount naming no PAT. Okay, guys, so it is a no PAT, and the afterwards the uh, notation given in our question, that is TCE. What does it mean? In our first formula, that is TCE. TCE, what does it mean? TCE. TCE means total capital employed. Total capital employed. Capital means all kind of capital. Capital means all kind of capital. That could be equity share capital, preference share capital, preference share capital, all kind of capital. That could be sometimes reserve. So these are the kind of capital can be sanctioned in our accounting problem. So these are the kind of capital. So according to format, this TCE have different kind of calculation. Okay, so after that we will calculate the meaning of that. So at first it was no PAT, we have discussed about no PAT. Now it is TCE. TCE means total capital employed in our business entity. The number of people, the number of investors have trade in our company, the kind of capital like equity capital, preferential capital, reserve capital. Okay, so that's enough for our to know about TCE. That means capital, total capital employed. Okay, so our next notation is WACC. WACC. This is a very important notation in our calculation of EVM. So, what is WACC? It means weighted average capital. It means it means weighted average cost of capital. Weighted average cost of capital. Weighted average cost of capital. We know the meaning of weighted average, the number of weighted given in our question, the weighted calculate through the past result, the history result, and we got the value of weight from our past in history result, and this is the average cost of capital. So what is cost of capital? What kind of average cost of capital is saying that the cost of capital means the cost of capital, that means cost of debt, cost of debt capital. Debt mean the um, money borrowed from this money borrowed from market. So this is the cost of debt. Debt mean that is kind of loan capital, loan capital. Debt, cost of debt, cost of equity, that is equity capital. Cost of debt, cost of equity, and cost of preference capital. Cost of preference cost of preference capital. So these are all have also some coding name. So cost of debts that identified with that k in suffix, that is k with in suffix, that is d, and cost of equity, that is k in suffix e and k in suffix sorry, is k in suffix, that is p. So these are the notation of cost of capital. Okay, so with these three kind of capital will make an weight equivalent to the proportion of each in the total capital. So we'll make this weight, will make this weight, will calculate this weight and weight equivalent to the proportion, weight equivalent to the proportion of each in the total capital, so here it is, guys, the real meaning, that is weighted average cost of capital. So this is the weighted average of cost of debt, cost of equity, cost of preference share capital. So these are the three meanings are given here. So in our next formula we can see that is OBVC. So what is OBVC? Now we'll discuss about this particular term that called OBVC. So what is OBVC? OBVC mean OBVC have formulated through this way. OBVC, that is opening sundry asset, that is opening sundry asset, this is opening sundry asset minus opening current current liability. Okay, so the OBVC formula is opening sundry assets minus opening current liabilities. So full form of OBVC is that opening book value of opening book value of capital, opening book value of capital, the OBVC full form. So OBVC doesn't mean what? Opening sundry asset, the asset minus the current liability. So what will be the valuing amount? So that will be called OBVC. So here it is, the meaning of OBVC. And now we'll got to know about spread. So we have already know the spread. What does it mean, spread? So I am here writing down the meaning of this term, and otherwise I will write down this meaning of for the full form of each and every notation and formula. So that is spread. And this is a term which I've derived from our calculation of EVA, and this is a very important part of our calculation of EVA. So spread, what does it mean? Spread means spread equals to spread equals to spread sorry guys spread is a financial 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 indicator financial indicator which financial indicator which is used to determine the growth of the firm, the growth of the firm. Okay guys, so what is spread? Spread is a financial indicator which is used to determine the growth of the firm. So this is the indicator which shows you the growth of the firm. Is the firm is making is the firm is going in every day? Otherwise no. So this will make you the determination to know about your firm's financial condition. So spreads, the formula of spread, return. So the formula of spread is return on NOPAT, minus WACC. So we have already discussed about that, WACC and return on NOPAT. So what is return on NOPAT? The return on NOPAT means you have already know what is NOPAT. So the return on NOPAT. So what is it valuing? So return on NOPAT is equals to NOPAT, that is net operating profit after tax, divided by total capital employed into 100. NOPAT by total capital employed into 100. So this is the formulating to how to calculate return on NOPAT. So these are all the formula, the notations I have discussed here. So now I will make each and so don't worry guys, I will make this clear to understand more on that. So what is the real notation, and I will give the computation of each and every notation like NOPAT, TC, WCC, OBVCs and spread. Okay, so guys, here we will make a long we'll make a bright heading, that is notation yes, calculation notations calculation. So at first it's the first name come is number one, that is number one, no pet no pet computation no pet computation. No pet computation. So how to calculate no pet? So guys, we will make here write it down particulars, and we will make an amount column in the right hand side. Amount in bracket rupees. Okay. The first thing, no pet. We'll write it here like that. Profit after tax mean profit. Sorry guys. Sorry guys. Yeah, I'm writing another formula. So just I've got to know that is different formula. I'm going to write it down. So at first we should know about the sales. The sales have made in our companies. So sales, and I am making this format. So I am getting the star instead of the particular amount. Okay. So sales less cost of goods sold. Cost of goods sold. Cost of goods sold. So I will make there another star, and the amount I got, that will be named like gross profit. Gross profit. Okay. Then less from gross profit, we have to deduct the operating expenses. You guys know what does it mean, operating expenses? Operating expenses mean the expenses directly related related the expenses directly related to the business process or production okay. So the expenses directly related to the business process or production system. Okay. So this is the operating expenses. I am going to deduct this amount from gross profit. So after making this amount, I have get this amount. So it will be named EBIT. EBIT. What does it mean, EBIT? EBIT have full form, that is earning before interest and tax. Earning before interest and tax. Earning before interest and tax. So I will make this notation through this star. So it is the amount valuing the EBIT, earning before interest and tax. So now I am making another star in regards to amount calculated of EVA. Oh sorry guys, I have already made this star wrongly. So EVA, EBIT, that is earning before interest and tax. From this very amount we will deduct the another things, less interest on borrowed capital. So what does it name, earning before interest and tax. And now I am making the interest and tax Now I am making payment of interest and tax. Interest on borrowed capital. Borrowed capital. Interest on borrowed capital, and it is valuing like that with this term. So interest on borrowed capital, and after deduction on interest on borrowed capital from EBIT, we have got to know the, the corresponding name of this amount, that is EBT. EBT, that is earning before tax, because we have already made payment of interest, so there is no interest to make payment again. So here we have got the rest of the thing, that is tax. So this is named earning before tax, EB and EBT, earning before tax. So it's valuing that one. And after getting EBT, now I will paid the amount less tax. If we deduct tax, the last thing, that is tax, if I made payment of that tax, then the amount we will get, that is EB, that is PAT, PAT or EAT, PAT or EAT, EAT or PAT, profit after tax or earning after tax. Okay guys, so it is earning after tax or profit after tax. It is the valuing amount of EAT or PAT. So from that we will deduct, so okay, sorry guys, not less, that will be add, and from PAT we will add interest on debt after tax. So interest, so it is profit after tax, and we need to know the net profit after net operating profit. Okay, so here it is the operating profit, and because after deducting the operating expenses from our net profit, we got to know from our net profit, after deducting the operating profit, then we got to know the amount that will be called operating earning or operating profit. So from this operating profit we will add interest on debt, interest on debt after tax. So from, so at PAT, profit after tax or earning after tax, with that we will add interest on debt after tax, so it will be valuing that, and after addition of that we will get this amount, which will be called, that amount will be called NOPAT, net operating profit after tax, NOPAT. So what is the NOPAT computation? So at first it is sale, so what our earnings, so from sales every business entity used to earn their profit. So from sales we are going to deduct cost of goods sold, and after deducting cost of goods sold from sales, you know that that will be called gross profit, and from gross profit we will deduct operating expenses. This is those expenses which are directly related with the operating things, the business process, from which the business making sell, and from which product the business making profit, the production of our company. So after deducting operating profit from operating expenses from gross profit, we got EBIT, that is earning before interest and taxes, earning before interest and taxes. So from that EBIT we have deduct interest on borrowed capital. The interest thing will be deduct now, we will make payment of that from EBIT, earning before interest and tax. We will deduct from this amount the interest, and after making payment of interest, then we got to know EBT, that is earning before tax, earning before making payment of tax. And after, and from this earning before tax we will make payment of tax, and after make payment of tax we have got EAT, that is earning after tax. Earning after tax means after making payment of tax from our earning. So that will be called that EAT or PAT, profit after tax or earning after tax. And with that we will add it interest on debt after tax. That is interest on debt. Interest on debt mean debt capital. That is that is notified with that particular code, that is KD. So cost of debt capital. So this is the return of cost of debt capital. The return of cost of debt capital, we will add this interest which we have to make payment instead of getting capital from debt. Okay, so we will add interest on debt, tax, interest on debt after tax. So how this calculation will be will going to make, so we will got to know through making a problem. Okay, so here it is, the completion of net operating profit after tax. You guys can make this video pause and write it down in your copy. Okay, so after that we will get to know what is trading profit, the current trading profit after tax. So it is a net operating profit, and simultaneously we should know, we should write it down in other side, that is, after that the net operating profit after tax, we got to know the another heading of, that is current current trading profit, current trading profit computation. Current trading profit computation. So we will make this payment of particulars, and in the right hand side we will write down the rupees column. So what is the purpose of write down this computation method, we will describe in our next video or in our next class. So now you should write it down as per I am write down it here. So we'll write down this like that: profit after tax. So after making profit, after making payment of tax from our profit, so we'll write down here profit after tax, after making of tax from our profit. So it will be amounting like that from star, and will less income from non-trading asset, less income from non-trading asset. Here guys, there is lot of things to understand with this method. So I am trying to make reach a particular place to make you understand each and every uh, kind of profit, each and every kind of concept, but I will try, because there is so much deep kind of things are here. So if I going to explain each and everything, so the video will about uh, 2 hours or 3 hours. So that will be not, we don't have so much time to understand each and every copy. So for that purpose I am going to make the maximum type of things. Okay, so then we will make that less non-recurring income, non-recurring income, non-recurring income. So what does it mean, we will describe in our next video, in our next class. But today at now, write it down through my class, that is in decrease in for future expense, future expense star, less increase in future expense, add abnormal loss, then less abnormal gain. From this method, we get to know current trading profit after tax. Profit after tax. So here it is, the current trading profit calculation are here. You can make pause the video and write it down in your copy. Okay, so there is all the calculation I've gone here. So now we'll make the calculation of another notation, that is number 3. That is number 3 of WSCC, that is weighted average cost of capital. So how to calculate this amount, that is weighted average cost of capital? So it will be, its formula is like that: K suffix D and D by D plus E plus cost of equity into E by D plus E. In here, D and E means debt equity ratio. Debt equity ratio. You'll get to know about this utilization of this particular term. So here it is, the WCC, and the cost of debt, that means K suffix D, that will be given in our question. If that is not given in our question, then you will calculate in that way. Cost of debt, that is R into 1 minus T. If the tax made payment after tax, I am writing here like that, after tax, or cost of debt equals to I means interest of debt by net profit, NP, into 100. So that is when cost of debt is before tax payment. Okay, so here it is, and now that is KE, the calculation of KE. So what is KE? That is RY plus RM minus RF into beta. So in here you can get another formula of KE, that is 1 by P, profit earning ratio, PE ratio, that is profit earning ratio, PE ratio, profit earning ratio. So from that video we have already known K, cost of debt, and there is two different kind of calculation of cost of debt. The first one is KD, that means cost of debt, the R into 1 minus T. R means the rate of interest into 1 minus T. So also in now that is KE, cost of capital, and it's valuing like that RY. So what does it mean RY? I'm going to write down this, and down that is RY. What does it mean RY? RY means RY means risk free, risk free, risk free rate of return, risk free rate of return, risk free rate of return, ROI. And what does it mean RM and RN and RF? RM and RF. What is it valuing? This is long term. This is long term market rate of return. Long term market rate of return. Long term market rate of return. So RM minus RF, that means long term market rate of return, and RM means, so there is no meaning of RM, otherwise I'll write it down here. There'll be no reason to make problem during this particular situation. Okay, so and the value of beta will be given in our question, so there will be no uh, confusion to know about the value of beta. Okay, and you guys should know about one thing, that is what is it, the value of beta. The beta, and guys, this the value of beta, the value of beta, that will be always more than 1, that will be always more than 1. Okay, that will be always more than 1, that will be never less than 1, so that will be always greater than 1. So value of beta is always greater than 1. Okay, value of beta will be always more than 1, and it will be take a highest of value of beta in our past years. So when we will do our first problem, then we will get to know about each and every concept of that. So now we'll becomes to know about, so how many kind of uh, formulate we have already given, that is number 3. Yes, that is number 3, and now we'll discuss number 4. Number 4, that is TCE. We have already discussed the full form of TCE already. So the value of the calculation of TCE, that is the first one is equity share capital. Equity share capital plus preference share capital. Oh sorry guys, I'm making the shortest notation to make this longest name preferential. So that is pref share capital plus reserve plus LTD minus fictitious asset. So here it is the formulation of TCE in 4 and 5. Oh sorry, there is another formula of TCE you can apply when there is lack of information. You can apply this formula instead of applying the first one, that is fixed asset as fixed asset plus investment plus investment plus current asset minus current liability. Current liabilities and provision. So here's the formula of TCE, total capital employed, and then fifth one is coming, that is OBVC. OBVC, the formulation of OBVC. Opening book value of capital. So it's valuing like that: opening sundry asset, opening sundry asset minus opening current liability. Opening current liability, opening current liabilities and provisions. And provisions. And the sixth one is average capital employed. Average capital employed. Average capital employed. So the primary calculation, that is opening capital employed, the capital employment, the capital invest in our business. Opening capital employed plus closing capital employed divided by 2. So this is the average capital employed. Otherwise there will be another formula to formulate this, to derive the average capital employed. So that will be TCE, total capital employed, minus half years of of current current trading profit. Now you guys can related that purpose to write down the current year trading profit calculation. So here it is to calculate the trading profit to derive the amount of average capital employed. So during this session I have written down this particular calculation process of current trading profit. So here it is, guys. This is the completion all about our formula through making our notations calculation. So here it is, the first one, that is notepad computation. You can take a screenshot, otherwise you can pause the video and write it down in that way. So if you take my opinion, then I would like to say that, so don't pause the video. At first you pause the video and take a screenshot, and then set that this screenshot in your gallery and write it down calmly through making your concentration and concept clearance. Okay, so notations calculation, the number one is notepad computation. The notepad computation is given here, that is sales. From sales we will deduct cost of the goods sold. After deducting cost of goods sold we will get gross profit, and from gross profit we will deduct operating expenses. So after deducting operating expenses from gross profit we will get EBIT, that is earning before interest and tax, and from earning before interest and tax we will make payment of interest of on borrowed capital. So after making payment of interest, then we will get earning before tax, and from earning before tax we will make payment of tax, and then we will get earning after tax or profit after tax. So after that we have to convert it into NOPAT, that is net operating profit after tax. So for that purpose we have to add the interest, but not the tax, because that is net operating profit after tax. So this is the valuing amount of after making payment of tax but before making payment of interest. So we have to re-add our interest in that uh, earning after tax. So after making this interest on debt after tax, that will be valued no PAT, or means net operating profit after tax. So then uh, in our next point we have calculated current trading profit computation. So we will make clearness of that particular calculation in our next video, when we will do certain problem where we have to calculate current year's trading profit, and then we got to know so it's not numbering, it's sorry guys, it's not numbering like KD. Okay, so we have made calculation KD from here. So KD, that means cost of debt, and we have calculated weighted average cost of capital. So how to calculate weighted average cost of capital, we have already described that here, and we got to know the real calculation method to understand what is weighted average cost of capital. And the fourth one is total capital employed. So that is equity share capital preference share capital reserve, limited liability uh, minus fictitious asset. Okay, so otherwise that is fixed asset plus investment plus current asset minus current liability and provision. You guys will get to know the correct or appropriate formula, when to apply that particular formula. So when you will get to know this particular thing, then you will apply according to your knowledge. And the fifth one is OBVC, that is opening book value of capital. So how to calculate OBVC, that is opening sundry asset. The sundry asset we have opening sundry asset minus opening current liabilities. So from sundry asset we will deduct our current liability, and we will got the value, that is OBVC. So and ever the last one, that is average capital employed, that is opening capital employed plus closing capital employed divided by 2. Otherwise if this information is not available in your question, then you will apply the next formula which is given after write down or, that is total capital employed minus half years of current trading profit. So to get the current trading profit, we have to follow the formula given below, the structure, the format given here, this current trading profit. Okay, so here it is the completion of all notations and calculation of notations through a particular format. And in our next video we will solve a practical sum of economic value added. Then you will get clear your all kind of confusion, and you will get to know the real meaning of to calculate economic value added. So economic value can be positive, can be negative, can be zero. So we'll get to know what we will get from our calculation of EVA, is that positive, negative, or zero. Okay, so here it is. That's all for today. That's all for with this video. In our next class we'll meet with a practical sum. Thank you guys, thank you so much.